Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, April 18th, and you are tuned in to a special edition of On Trend. I am on vacation this week, but I'll be back next week, and today I want to talk about breadth indicators. We're going to define them. We're going to show you how to use a weighted approach to broad market analysis. We're going to break down the sectors and sector breadth indicators and show you how to use breadth indicators for charting and scanning. I would also invite you to check out the Arch Charts commentary for Thursday, April 18th. It is members only, but I'll have some charts in there, some chart links, and some scan code. So we're going to be using Advanced Decline Percent, which is a daily breadth indicator, and we're going to use it for the S&P 500, some other indexes, as well as the 11 sector SPDRs. And I'm just going to explain where this comes from and what Advanced Decline Percent exactly is. So here we have New York Stock Exchange advances, you can see in the second window. Then we have New York Stock Exchange declining issues, the red there. And then below we have advances and declines. And I'm using something called up-down pair to plot these two symbols as an up pair, which would be the advances, and then the down part of the pair would be the declines there. And if you scroll down, you can't scroll down, but I'm scrolling down. There you see price up-down pair is the selection there, and there are the two indicators separated by a comma. So from advances and declines, we get net advances, and that is the bottom indicator. And you can see there's an indicator actually for NYSE net advances, $NYAD. And so that's advances minus declines. And so you can see when there are more advances, this is positive, and when there are more declines, this is negative. So from net advances, which is in the middle window, we can calculate advanced decline percent. And that is net advances divided by total issues. And you can see for this indicator, I've entered $NYAD colon for the division $NYTOT as an indicator, and that is in the parameters box. So you see price, and there you can see that indicator to divide those two. And so I get net advances percent, and that normalizes it. So it fluctuates basically between +1 if you had all advances and no declines to -1, but usually it's in between those two. You can see it was at -60 on this last reading here, and there's a reading above 0.50. And of course, once we know the symbol for net advances or advanced decline percent, we can make an AD line. So this is advances minus declines, net advances with the histogram, and then there we have the AD line, which is a cumulative reading of net advances. And if you scroll down, you can see how to do that. There is the symbol $NYAD, and for the style, I've got cumulative. Now, before we move on to S&P 500 AD percent, I just want to highlight a pet peeve of mine that I do not like to see. I do not like to see a comparison between the S&P 500 chart and the NYSE AD line. There you can see there are the two there, because the basic reason is only 2/3 of stocks in the S&P 500 come from the NYSE. 1/3 come from the NASDAQ. So if you're only using the NYSE AD line, you're missing 1/3 of that index there basically. And just to prove that, I ran a little scan. The group is the S&P 500. The exchange is the New York Stock Exchange. And when you run that scan, you can see that we only have 369 issues that match those results out of 500. So that means another 131 are coming from the NASDAQ. Another reason not to plot the New York Stock Exchange AD line with the S&P 500 is we have indicators where you can plot an AD line specific to the S&P 500, S&P Small Cap 600, S&P Small Cap 400. And these indicators are based on advanced decline percent. So here you can see we have S&P 500 advanced decline percent in the indicator window, $SPX ADP. And if you want mid-cap AD percent, you just substitute out SPX for MID. Small caps would be SML, NASDAQ 100 would be NDX. And of course, there's the formula. Basically, advances minus declines, net advances divided by total issues. So if you have 450 advances, that's going to be 90% of the index is up. That's like a 90% up day. And if you have 50 declines, you're going to have plus 400 net advances. And that is going to equal 80%. So if you get an 80% up day in advanced decline percent, that's equivalent to a 90% up day as far as 90% advances. Similarly, if you get a minus 80% down day, that's going to be similar to minus 90% of stocks in the S&P 500 declined. So in this chart, I'm showing advanced decline percent as a histogram, which makes it much easier to read. And you can easily see when we have these days above plus 80% and below minus 80%. And then I just use a cumulative indicator feature for price to create the AD line for the S&P 500. And then I overlaid the S&P 500 so you can easily compare movements in the AD line and in the S&P 500. So now we've set the stage for the first breadth indicator that I'm going to use to get a weight of the evidence approach to the broad market trend. And we're going to apply this indicator to the S&P 500, S&P Mid-Cap 400, S&P Small Cap 600, and the 11 sectors later on. So you can see here that this is the 10-day EMA of 80%. I prefer it to the AD line because what I'm looking for is a breadth thrust, either up or down. Now, you can choose your own levels, but I've gone over this and I've decided to use minus 30% for a bearish breadth thrust, which you can see we got in October on the 11th. And then you can see we did get a bullish breadth thrust in early November, another one in mid-December, and another one in January. Now, they usually don't happen this often. And as you'll see, we didn't get them in the mid-cap and small-cap indicators for confirmation. Confirmation is key. But we did get one in early January there, and that foreshadowed the extended advance into February and March. Now here are the three AD percent indicators for the three indexes I just told you about. There you can see S&P 500, mid caps, and small caps. And we can compare the degree of participation on the upside or the downside. That's what this indicator does. And so you can see here on this decline that we had in March there at the end of March, the S&P 500 did not go below minus 80%. But mid caps and small caps did. And you can see small caps bore the brunt of the selling pressure. So that's kind of like a one-day downward breadth thrust. Now, as I said, I do not use just one index and one indicator, basically. I'm using this indicator, but I'm applying it to all three indexes. So you have three indexes. And so when two of the three trigger bullish breadth thrusts, that's net bullish. When two of the three trigger bearish breadth thrusts, that is net bearish. And so we can see here that we had 3 of 3 triggering bearish on October 11th and again in December. And then we had the bullish breadth thrust with 3 of 3 in January. So using that confirmation, you can avoid some whipsaws here. And if we look at the individual indicators, there we can see all three triggering bullish in early January. If we look back to that November signal in the S&P 500, you can see it was not confirmed by mid caps or small caps. And currently, we'll just keep watching this indicator and it'll turn bearish if two of these three move below minus 30%. Now, the next indicator group is HighLow Percent, and this indicator is used to measure the percentage of stocks that are, say, in strong uptrends versus strong downtrends. If you're hitting a new high, you're in a strong uptrend. If you're hitting a new 52-week low, you're in a strong downtrend. So I've got this indicator again for the S&P 500, S&P Mid-Cap 400, and S&P Small Cap 600. And you can see all three triggered bearish there on October 11th when we had that move below minus 10% in all three. And that is my threshold, minus 10%. And the reason I'm not using the 0 level or even say plus 5% or minus 5%, something in between, is because I found you get too many whipsaws. All right, you can see here we turned positive and it didn't last very long. Again, we turned positive, it didn't last very long. So we need a move above plus 10% to show some critical mass, enough critical mass on the upside, enough new highs to power an uptrend. And if we get below minus 10%, that tells you that new lows are expanding, strong downtrends are expanding, and that is a bearish signal. So if we look at the current situation, you can see the S&P 500 triggered bullish in mid-February, but we have yet to trigger bullish in mid caps or in small caps. So 2 of the 3 remain on bearish signals until they get a bullish signal, obviously. And so this indicator group is net bearish. Now, the third and final indicator group is the percentage of stocks above the 200-day EMA. And this is measuring trend participation. So in the advanced decline indicators, you're measuring participation for the upside and the downside in a short time span, 1 day to 10 days, basically. The high-low indicators are longer term because they're looking for 52-week highs and 52-week lows to identify stocks in strong uptrends versus strong downtrends. And then the percentage above the 200-day EMA is just a broad trend participation indicator. And we can see that I've got levels here at 40% on the downside and 60% on the upside. And I don't use that 50% line because, as you can see, you're going to get lots of whipsaws. Again, I'm looking for critical mass on the upside and the downside. So when you get above 60%, as we did here in early February, I think that shows enough critical mass on the upside, enough stocks and strong uptrends to warrant a bullish bias in the broader market. And you can see we got some follow through with mid caps a little later in mid-February, as well as small caps. And now we're starting to get some weakness because you can see small caps have moved below minus 40%, but we have yet to get confirming signals from large caps or mid caps. But when one of these triggers and the other one's already triggered, that would mean 2 of the 3 are net bearish, and that would flip this indicator to bearish. So in the ARCH charts commentary, I have a table that I regularly update, and it shows all of the signals that I just showed you for the 3 major indexes and the 3 breadth indicators. So you have 3 indexes, 3 indicators, that's 9 signals. And basically, the green boxes show the bullish signals and the date, and the red boxes show the bearish signals and the date. And I got a blue oval there on the 22nd of March because we got a new bearish signal. Now, this is obviously pre-recorded when you're watching it, but the idea of this video is to show you how I use these breadth indicators so you can understand them and use them yourself and even tweak them if you would like. So currently, 6 of the 9 indicators are on bullish signals, so that's 2/3. So you can see the market is not strong throughout because 1/3 are on bearish signals right now. And the net has been bullish. 5 of 9 indicators have been bullish since mid-February. So if we get another indicator that flips, and if we get 5 of 9 bearish, then that would turn the bulk of the evidence, the weight of the evidence, bearish for the stock market as far as I am concerned. And that's where the weight of the evidence comes from. So I also look at the major indexes and use a 200-day moving average and a 20-day moving average. And if you want to know more about that, there's a video from Thursday, February 21st in the On Trend archive, and you can learn all about moving averages and how they performed over time. They're not perfect, but they do give us a general idea of the trend, especially with the S&P 500. But I also look at these 3 major index charts, and you can see the S&P 500, it just edged above the November highs, but you can see that mid caps just edged above, but small caps did not. And mid caps and small caps are turning down, it looks like, at the 200 days, and the S&P 500 is outperforming, but we're getting some serious weakness coming from mid caps and small caps. But the main signal to watch for me is if that 20-day moving average moves below that 200-day, then I think we have a bearish signal to be concerned about. Now we're going to turn to the sector SPDRs and look at some sector breadth indicators. But before I do that, I want to just review the sectors so we fully understand why I'm looking at the breadth indicators for a broad market assessment. First and foremost, the sector SPDRs are weighted towards market cap, which means the largest stocks in those sectors dominate. And you can see here the XLK currently has around 35% weighting from Microsoft and Apple. So these two stocks account for over 1/3 of the ETF. So it is hardly representative of the technology sector as a whole just because of that serious overweighting in just two stocks. And that's why we need to use breadth indicators to even it out, to look at the sector as a whole. Sure, we could look at the equal weight technology ETF as well, but I like to look at the breadth indicators so I can build a table and I can see in an objective manner what the weight of the evidence is based on the sector performance. So again, here's technology. It's 21% of SPY, by far the biggest sector out there, and there you can see the top holdings. If we look at healthcare, it's the second biggest sector, 14.68% of SPY. And there you can see the top holdings, mostly dominated by the big pharmaceutical stocks with a few biotech and health medical devices thrown in. We look at finance. It is the third biggest sector, 12.94% of SPY. Berkshire, which is really not a bank or an insurance company. It's kind of like this holding company that buys up businesses, but it's 13% of the ETF. JP Morgan, 11, Bank of America, 8. So, you know, these three are over 30% of the ETF. So if you're interested in XLF, you best be following these three. Now, if we look at communication services, we can see it's 10% of the S&P 500. And look at this, two stocks account for over 40% of the sector SPDR here, Google and Facebook. And frankly, I think this is the silliest sector out there because, you know, this is just a hodgepodge of businesses that really don't correlate, I don't think. I mean, you have Google and Facebook. Okay, they probably correlate. Then you have Activision Blizzard, which is a video gaming stock. Then you have cable television. Then you have the cable disruptor, Netflix. And then you have the old telecoms that are trying to get into things and another video gaming stock. So it's a very weird sector, I think. But nevertheless, it's got Google and Facebook and some other important stocks. So we keep track of it in our sector performance table. Next, moving on to consumer discretionary, we can see that this one is dominated by Amazon. Over 24% of the ETF is accounted for by Amazon. So you better watch Amazon if you're interested in XLY. And it accounts for 10% of the S&P 500. And next up, you have Home Depot at almost 10%. Then we have industrials, and we can see that the biggest holding is Boeing. And that holding, of course, dropped significantly with the Boeing decline of late. And you can see that the sector is around 9.37% of SPY. Now I'm going to take a little detour here and show you a table that lists the sectors sorted by their weighting in the S&P 500 SPDR SPY. And then we're going to see technology and then the other top 5. So in total, the top 6 sectors account for a whopping 78.35% of SPY. So that leaves the other 5 sectors to divide up a little over 21% for a piece of the pie here. And consumer staples is next at 7.17%. Energy is under 6%. And then you have the bottom 3, utilities, real estate, and materials at somewhere between 2.65 to 3.3%. But the main point here is that if you're doing broad market analysis, you need to take these weights into consideration. And, you know, technology, healthcare, these top 6 are the ones we need to focus on as far as the broad health of the market is concerned because they're the main drivers. The other ones are kind of like rounding errors almost. So briefly, these other 5 sectors, you can see that the top holdings in XLP are Procter & Gamble, Coke, Pepsi, and Walmart. So those 4 stocks account for over 40% of the ETF. Then we look at energy, and we can see that ExxonMobil and Chevron account for over 40% of the ETF. They are clearly the big drivers there. Then we look at utilities, and you can see the top 4 holdings there account for over 30% of the ETF. And one thing about utilities is they are very highly correlated to each other. So this is one sector that does make sense as far as being homogeneous. And then we look at REITs. They as well are pretty highly correlated to each other. And you can see that the top 3 or 4 REITs account for the lion's share of the ETF. And then we look at materials, which is the smallest sector, and you can see that Dow DuPont is 20% of the ETF, and then we have Lin and Ecolab. So there you can see around 45% or 42% of the ETF in 3 stocks. Now, the same breadth indicators that I showed you at the beginning, the 10-day EMA of 80%, the HighLow Percent indicator, and the percentage above the 200-day EMA, those indicators can be charted for each of the 11 sector SPDRs. And I've got 3 of them on one chart here for XLY. There you can see XLY ADP. So you just substitute out the sector symbol if you want technology, XLK ADP. Then we have HighLow Percent, XLY HLP, and we have the percentage of stocks above the 200-day EMA. And I've got the same levels for signals. You can see a move above plus 30% is a bullish thrust, and a move below minus 30% would be a bearish thrust, as we got in October there. You can see when the indicator moves below minus 10% for HighLow Percent, you have critical mass for new lows, and that's bearish. And then when you move above plus 10%, you're getting enough new highs to power an uptrend. And then for percentage above the 200-day EMA, you move above 60%, that is bullish. You move below 40%, that is bearish. And you have 3 indicators here, so I take 2 of the 3. So when 2 of the 3 are on bullish signals, I'm net bullish on the sector as a whole. And then I put them all these signals in one table to get an idea of the broad market environment. Now you can also chart the individual indicators on one chart for each of the sectors. So here I've got HighLow Percent. I've got the indicator for the S&P 500 at the top here. And then I've got the top 6 sectors that account for 78% of the broader market. Technology, HighLow Percent, healthcare, finance, industrials, and I'll scroll down in a second here. But you can see technology is getting a lot of new highs there in February, March. So it's clearly one of the stronger sectors. Healthcare is not doing too bad with a number of new highs. Finance, less so, could barely get above 10%. And then if we scroll down a little bit, we can see industrials barely above 10%, but still more bullish than bearish. We look at communication services above 10%, so more bullish than bearish. And we look at consumer discretionary. It was doing all right in February, but not as strong in March. And again, I'm not looking at signals for a move above or below 0. I'm looking for a move above plus 10% or below minus 10% to avoid whipsaws. So to get a weight of the evidence approach for an objective look at the broader market through these sector breadth indicators, I put them all on a table, and this is updated on a regular basis in the Arch Charts commentary, usually on Fridays. It is behind the paywall, so it is for members only, but it gives me an idea of how the broader market is performing. And so what I do is I just mark the bullish signals with green and the date, and the bearish signals with red and the date. And currently we have 27 bullish signals and 33 bearish signals, but I also apply a weighting. So I take the signals, and if we're net bullish, 2 of the 3, then we get a green for net bullish. The only one that is net bearish is energy, with 2 of the 3 indicators still on bearish signals. And so I take the number of signals and multiply it by the weight. So you have 3 of 3 bullish signals for technology. So the full weight is applied to that signal. And then we have 2 of the 3 bullish for finance. So only 2/3 is applied for that weight. And then for energy, we have 2 of the 3 on bearish signals. So 2/3 of that negative weight is applied. And then I sum it all up and we get 81% bullish based on the weights. And so when this goes below 50%, then we have a weight of the evidence approach that tells us that the market has shifted to bearish. Now keep in mind, this only applies to the S&P 500, but if the S&P 500 is net bearish, you probably don't want to be in stocks. All right, now I want to show you where you can find some of these symbols, how you can analyze them using summary view and a chart list, and how you can scan with these signals for some analysis. So I'm here on the charts and tools page, and if you go to the search icon in the upper right and you just type in, say, advance and decline and percent, and then click go, you'll get some results for support articles. But that's not what we want. If you go down to the bottom and you click the symbols button, you'll get all the symbols that have advance and decline and percent. And there you can get these breadth indicators for the sectors. We also have it for gold miners and some indexes and the Dow transports. All right, we can also change that search. If we want to do high and low percent, we can also find those indicators and these symbols. So I created a chart list, and it is called Breadth Scan, HLP, for HighLow Percent. And there you can see I entered the names, and I prefaced the index names with an index, and then the sectors, so they keep a nice sort there. And there are all the symbols. And once you have all these in one chart list, we can click the View and click Summary for View List As. And here we can see the actual values and do a sort. Now, I don't need all the columns here, so I'm going to remove the date, and I'm going to keep the close, and I don't need the change, believe it or not. And then when I'm done, I can just click anywhere. I'll go ahead and shrink that a little bit. And now I can sort by the close to see where the most new highs are. And there we can see utilities and REITs and consumer staples are rising to the top. All right, there's the S&P 500, kind of a benchmark. Everything above has more new highs relative to the S&P 500. Everything below has fewer new highs. And look at small caps actually have more new lows than new highs. We can also run a scan on a chart list. Here I've created a chart list with the advanced decline percent indicators, and I want to scan all of those indicators, and I want to rank them by the 10-day EMA, which is my breadth thrust indicator. And when we run that scan, there we can see all of them, and there we are ranked by the 10-day EMA of AD%. So we can see which ones are the strongest over this 10-day period and which ones are the weakest. So you can also find a list of stocks making new highs from our predefined scans. So here I am on the charts and tools page, and if you scroll down that right navigation, you'll see a link for predefined scans, and at the top you will see new 52-week highs. You can click on the number for the NYSE or the NASDAQ to find stocks making new highs, and you might want to put those on your watch list. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to check out that commentary from the 18th. Have a great day, and I'll talk to you again next week.